टेस्टिंग 1 2 3। कहाँ पे गया और कहाँ पे नहीं गया? तो यहाँ से जाऊंगा तो फिर वही पूरा मसला ना। ये नहीं हुआ ना, ये आपने कंप्लीट नहीं किया ना बेटा। वीडियो सोर्स नहीं कनेक्ट हुए। ये चलो। क्लोज कर दो। फेसबुक से ले लो। Hmm. Okay, hi guys, I hope ये क्यों ऐसा हो रहा है? Okay, hi guys, I hope you people are doing well. Just allow me 2 more minutes and we are going to start off. Sorry to have kept you people waiting. Just allow me 2 more minutes. Inshallah, I'm going to start off. देख लेते हैं। वो निपटा के चले जाओ, चले जाओ। अब आप अपने कॉल पे हैंडल कर लेना उसको, हैंडल कर लेना। ये दरवाजा बंद कर दो। Okay guys, welcome to this ACCA. Okay guys, so welcome to this ACCA SBR Revision Marathon session for the September 2023 examination session. Um, my name is Luqman Rafiq and I shall be taking you people through this specific SBR Revision Marathon session. Before I proceed, let me just guide you people a bit about myself and a bit about what we would be doing in this specific session. So first of all, about myself, I have been in teaching profession for more than 13 years now, and I've been teaching different qualifications, including the ACCA, the ICAW, the ICAP of Pakistan, and some other qualifications. Plus, I've been teaching different subjects, including the financial reporting, including the financial management, performance management, and auditing. There have been different subjects that I've been teaching over a period of time. The whole objective and the whole agenda of the session of today is that we want to make sure that we go through the maximum exam practice questions on the ACCA SBR, and I take you through these examination questions, revise the different concepts that are involved, and then we actually try to attempt these questions on the Excel. I won't be using the ACCA CB practice platform. The reason for me not using the CB practice platform is that unfortunately, when you use the CB platform, you just cannot save the answers to the questions in the Excel format. So just to ensure that I'm able to share the handouts with you, I'm able to share the workings with you, I'll just make sure that I do it on the Excel so that I could share the solutions and that you could actually benefit out of those solutions. So for those of you who are actually part and parcel of the session, what I would actually do is that there is a WhatsApp community that I have for the ACCA SBR. What I'll be doing is that I'll be sharing the link to that community with you people, so that if any one of you would like to join in, they could just join in. The handouts have also been shared onto that community. Plus, this video is right now being live streamed onto Facebook, live streamed onto the this is being live streamed onto the WhatsApp, everywhere this is being live streamed onto, right? So just for the sake of you people getting to know, because a lot of students, they come and ask the question that would I be getting the recording? Ideally speaking, if you don't go for the recording but rather continue this live session with us, that actually helps you. But just in case if you are stuck somewhere, or if you have got some commitments, or if you have got some issues, then obviously you could just go for the recordings and you could review. Now, when you are live, the advantage of you being live with us is that you can ask the question on a regular basis and you could just get your answers to the questions then and there. But it's still, again, I mean, like I do understand that a lot of students, they've got their own commitments. The time may not be suitable for many. So there could be multiple things that could happen. So just in case, if you're not able to join in live, you could watch the section, you could watch the lectures later on at your own convenience. We would be just making it available for you people. So before I start off, if any one of you have got any questions, you are most welcome to ask those questions. I'll be happy to answer them. So just in case if you have got any questions to ask, just let me know. I'll be happy to answer them. Yeah, just in case if any one of you would like to ask anything, you are most welcome to ask. I will be happy to answer before I proceed, and I could just go on with my own thing. My voice is breaking. Is it still breaking, Ijaz Ahmed? Is this the issue with everyone in here that my voice is breaking? Is this the issue with everyone here? Yeah, is this an issue with everyone that my voice is breaking? Okay, lovely. Good enough. So let me just start off and let me just take you people through. Okay, I have just taken out a few questions with for the session of today, and I'm gonna start going through those questions so that you people could actually have an idea that how to solve those questions. The first question that I have in front of me is basically one of the questions from the recent examination. I've taken out some handouts, some extracts from the Kaplan kit. So the first one that I have with me is actually the question which is named Sterling Company. I repeat, the first question that I have is the name of the question is Sterling Company. So I'm actually going to take you people through this Sterling Company question, and we're going to start discussing that what is there with respect to Sterling Company. Again, as I told you that I shall be doing this question on the CB, not on the CB platform, but rather I would be going through the question through the Excel so that you people have an idea that how to handle these questions. So let's just start off, let's just start discussing. This is one of the question, the name of which is Sterling Company. Obviously, the question is not molded according to the new format. The new format is that you would have a pre-prepared sheet, the Excel sheet, where you would have to actually prepare either a trial balance completion or maybe income statement completion or maybe the balance sheet completion, things like that. So let's just start off, let's just start discussing. It says Sterling Company is currently, I repeat, Sterling Company is currently preparing its financial statement. What does it say? It says Sterling Company is currently preparing its individual and consolidated financial statement for the year ended 31st March 2009. So you're preparing individual and consolidated financial statement for 31st March 2009. Now what else is there? It says the following exhibits available below provide information relevant to the question. Now, what is the information that is being provided? It says acquisition of Berthold Company. Now, what is this acquisition of Berthold Company? It says this describes the purchase of 40% of the Berthold Company on 1st January 2007 and a further acquisition of 35% on 1st December X8. So 1st January X7, 31st December, 1st December X8, this is how the acquisitions have taken place. Then it talks about investment in malting company. Investment in malting company describes the purchase of 30% of malting company on 1st July 8. So on 1st July 8, there is a 30% acquisition of malting company. Then batch company, which is a discontinued operation. I'll just go about discussing few things. Describes the acquisition of batch company, that is Sterling company decides to sell on 1st January X9. The information should be used to answer the question requirement within your chosen response option. Now, before I go on to discuss this, I would talk about the questions requirement so that I'm able to connect that what are we required to do actually. Now it says using exhibit number one, explain how Berthold company will be accounted for, including the calculations in the Sterling company's consolidated statement of profit or loss for the year ended 31st March 2009, and explain and show how the goodwill in Berthold company would be calculated at 1st December 8. So it's a 8 plus 6, 14 mark requirement. What is it? It is actually a 14 mark requirement. So what do we need to do? We need to actually discuss about this 14 mark requirement, and we need to solve the things that how exactly are these things gonna be accounted for. Now, first of all, if I go on discussing about this Berthold company, I would want to actually start discussing uh, I would want to start discussing about few things so that I can take you people through. Okay, let's just start off. So basically, with respect to this Sterling company, with respect to this Berthold company, let's try to understand few things before we start doing this scenario. Now, you know this thing that when we talk about the investments, so there are different categorization, different classifications for the investments. So when I talk about the different classifications for the investment, so one of the classification is that of an associate. The other classification is that of a subsidiary. When we talk about an associate, when we talk about a subsidiary, so what exactly are the differences? So when I talk about the associate, what is an associate? An entity, an entity upon which significant influence is exercised. So it's an entity upon which significant influence is exercised. So when we talk about, I repeat, when we talk about the concept of this Sterling company, the first thing is that you need to understand that associate is an entity upon which significant influence is exercised. Now, when I talk about the concept of significant influence, there is something that you need to understand. And what is it that you need to understand with respect to significant influence? The significant influence is actually, when we talk about the significant influence is actually the power to participate in decision making. So we know this thing that when we talk about the power to participate in decision making, this power to participate in decision making, how does it arise? This power to participate in decision making actually arises through how? It's basically like this. It's actually through BOD representation. This is through BOD representation. And when we have got an associate where we exercise the significant influence, what we do with respect to associate is that we account for the associate using equity method of accounting. I repeat, for what we do is that we account for the associate using equity method of accounting. I'll just go about discussing the equity method of accounting also, but before that, let's have a quick recall of the basic concepts. Now, similarly, when we talk about a subsidiary, so you know this thing, that what is a subsidiary? A subsidiary is an entity upon which investor exercises control. So a subsidiary is an entity upon which the investor exercises the control. So I repeat, entity upon which the investor exercises the control is actually going to be subsidiary. And when we talk about the control is basically have a certain definition, which obviously we're going to come back again when we are going to be discussing it again. So the entity upon which the investor exercises control is going to be a subsidiary. And we know what do we do with respect to subsidiary is that we actually consolidate subsidiary. We actually consolidate subsidiary. Now, if I talk about the concept of this equity method of accounting, let me just give you a bit. So when we talk about this equity method of accounting, how do we go about with the equity method of accounting? So with respect to the equity method of accounting, what we do is that there is a separate accounting with respect to the SOFP, and there is a separate accounting with respect to SOCI. With respect to SOFP, what do we do with respect to SOFP? With respect to SOFP, we actually present a single line item. What do we do? We actually present a single line item as investment in associate. So I repeat, when we talk about the equity method of accounting, what do? We present a single line item, and that single line item is shown as investment in associate. That's the first thing, which is investment in associate. Now, how do we show this investment in associate? So this investment in associate is being shown like that. What do? We say cost of investment. After the cost of investment, what we do is that we add up share of post acquisition reserves. So whatever the post acquisition reserves of the associate, you simply add them up. How do we add them up? Let's say, for example, if you have got 30% shareholding, so you'd simply say that 30% uh, current net assets minus acquisition date net assets multiply by this, so you resultingly end up getting the investment in associate. And what we do is that with respect to this investment in associate, this figure is shown in the SOFP. This figure is shown in the SOFP, the investment in associate. Similarly, if I talk about the statement of comprehensive income, so with respect to statement of comprehensive income, what happens is that let's just try to understand this. With respect to statement of comprehensive income, again, for the statement of comprehensive income, what we do is that we present. Okay, just a second. Some of the students are complaining that the screen is quite blurry. I have got I've got the Zoom screen open in front of me, and it's perfectly fine with me. So when it's perfectly fine with me, so it should be fine with almost everybody here. The reason being that I'm also being connected on the Zoom through another screen. So it should be same. It should be clear with everyone. Is it? Is it clear with everyone? Yeah. Can you people just confirm? Can one or two more confirm that if it is clear with you people? Okay. Then I'm sorry. Those who are having this blurred screen, please just try to reconnect your internet or maybe change your internet or something. Okay, so again, what happens is that with respect to statement of comprehensive income, what we do is that we present a single line item. What is that single line item going to be? That single line item is going to be, you would show um, the share of profit from associate, share of profit from associate. So whatever the profit after tax is, let's say if you've got 30% holding, so whatever the post acquisition profit after tax, you multiply with that and you actually apply it. So that's a single line item that you show with respect to statement of comprehensive income also. So whenever we have an equity method of accounting, that's how we do it. Now let's move a bit forward and let's talk a bit further. The next situation that I want to discuss before I go on to talk about the Sterling company is that I want to talk about the situation of step acquisition. Now, obviously, there are multiple scenarios with respect to step acquisition. What I'm going to be discussing now is what is prevalent in this specific situation. So when I talk about the concept of a step acquisition, the step acquisition is when you acquire a company in different steps, different stages. That's what is considered to be a step acquisition. Now, generally speaking, what happens is that the step acquisition could be like this. You have a 5% shareholding, you go on to 70% shareholding. You have a 25% shareholding, you go on to 70% shareholding. You have a 50% shareholding, or let's say 55% shareholding, and you go on to 70% shareholding. So the step acquisition could actually be different types. Now let's talk about the step acquisitions being 5 to 70, 25 to 70, 55 to 70. So what's happening? Here it's actually a simple investment under the IFRS 9. It's simple investment under IFRS 9 and it's becoming a subsidiary under IFRS 10. It's an associate under IAS 28 and it's becoming a subsidiary under IFRS 10. It was a subsidiary under IFRS 10 and it's a subsidiary under IFRS 10. So basically there are three different type of scenarios. An investment converting into a subsidiary, an associate converting into a subsidiary, a subsidiary in which your shareholding is increasing. So all three type of acquisitions are being dealt in a different manner. I'll just take you people through that how exactly would you deal with all of these situations before I go on to examination scenario, because right now in this scenario this is the case which is available. So I'm just going to talk about this case and then we are going to take things forward. So for example, if you have got an investment where you had an associate, and from associate if you are becoming a subsidiary, I bet you had a company which was an associate, and from associate it is actually becoming a subsidiary. So what is it that you have to do? Just try to understand. You have to remeasure existing. You have to remeasure the existing investment to fair value. Any gains or loss to be recognized in profit and loss account, right? So you have to remeasure the existing investment to fair value. Any gain or loss shall be taken to P&L. That's what you would have to do. Now let's discuss a bit further. Let's talk a bit further about it. The next situation that you need to understand is that I've just told you that associate to subsidiary, what you have to do. So when we talk about the existing investment to fair value, what is the existing investment that we would be remeasuring? So it's actually the existing investment is going to be your investment in associate. So whatever the carrying amount of associate that you have, you would be actually remeasuring it to fair value. Gain loss would be taken to P&L. Now there is one more thing I want you people to understand, which is when we talk about individual financial statement, when we talk about the group financial statement, I repeat, you talk about individual financial statement, you talk about group financial statement. There is a different method of recognizing the gain or loss, because you see in the individual financial statement You have a choice that you could be measuring your investment. You have a choice, you could be measuring your investment at cost, or at fair value through P&L, or at fair value through OCI, or using equity method of accounting. You have a choice. But with respect to the group financial statement, generally speaking, what we do is that we measure the investment in associate using the equity method of accounting. I repeat, we measure the investment in associate using the equity method of accounting. So let's say in the individual financial statement, if the investment in associate is carried at cost, and if in the group financial statement it's being carried using equity method of accounting, then obviously there is going to be a difference. I repeat, then obviously there is going to be a difference, and we need to be considering, we need to consider that difference accordingly, right? So there has to be a difference, and you would have to consider that. Now let's just start off and let's just start discussing things about this specific situation so that we could move forward. This was the question, the name of which was Sterling Company, and the first scenario is about Bert Hold Company. Now, what is it? It's actually about Bert Hold Company. So just to make sure that I'm able to give this a picture in a single page to you people, I could just go on to paste it here so that we could see the whole scenario in front of us on a single page rather than going here and there, right? Okay, I think it's very clear now. Just one thing, basically we are trying to solve the question for the year ended 31st March 2009. What are we trying to do? We are trying to do it for 31st March 2009. There are two requirements. One of them is how it would be recorded in consolidated P&L, and the second thing is that how goodwill in Berthold should be calculated at 1st December 8. That's what we have to do. So let's just start off, let's just start discussing. When you talk about 31st March X9, that means we are talking about 1st April X8. 31st March X9, you're talking about 1st April X8. 1st April X8. YouTube पे जा रहा है? मुझे नजर नहीं आ रहा. Hmm? जी? Hmm? नजर नहीं आ रहा है, किस पे जा रहा है ये? स्क्राइबर एकेडमी पे. Hmm? यार इसकी जो है ना वो सेटिंग चेंज करनी पड़ेगी पावर की. ये बार बार जो है ना वो स्लीप मोड पे चला जाता है. क्या करूं? स्क्रीन एंड स्लीप. नहीं बताया, वहां से देख लो, अगर कर सकते हो तो कर लो। प्राइवेट में जा रही है ना, प्राइवेसी। ठीक है, बता। Okay, so um, let's go through this specific scenario. It says Sterling company paid $25 million for 40% of Berthold company's 10 million $1 ordinary shares on 1st January 7. So what did they do? They paid 25 million for 40% of the 10 million ordinary shares. So if I talk about this Berthold company, so number of shares acquired is 40% into $10 million, 10 million shares. The cost was $25 million when Berthold company's retained earnings were $18 million. Next, it says Berthold company has no other reserves. Sterling company exercised significant influence over Berthold's financial and operating policy decisions. A further 35% stake was acquired on 1st December 8 for $41 million. 1st December X8 additional shareholding, which is 35%, was acquired. The cost that you paid was $41 million. The cost that you paid was $41 million. Now, it says that when the fair value of identifiable net assets was $55.3 million. And Berthold retained earnings were $42.3 million. Then it says the difference between the fair value of identifiable net assets and liability and carrying amount related to non-depreciable land. So any fair value adjustment that was there, that was pertaining to the non-depreciable land. The market price of the shares immediately prior to 1st December 8 was 9.2 per share. Sterling measures NCI at fair value. At the date of acquisition, goodwill is not impaired. Berthold company reported a profit for the year ended 31st March 9 of $11.1 million. So what did they do? They reported a profit for the year ended 31st March 9 of $11.1 million. Now just try to create a picture of what is going to happen with respect to Berthold company. So I'm just going to create a picture for you people, then I'm going to solve it all. First thing is that 1st April X8 till 31st March X9, this is the period. 1st April X8 till 31st March X9, this is the period, right? So this is the period. Now what actually happens is that 1st December X8 is the date when you have acquired additional shareholding. So for this period, it was an associate. For this period, it was a subsidiary. So there is a period for which it's an associate. There is a period for which it's a subsidiary. This date of 1st December 8 is actually the date when the additional acquisition took place. So what actually happens is that for this specific period, you will apply equity accounting. At this date of 1st December X8, you would be calculating goodwill. For this period of 1st December till 31st March 9, you would actually be doing the consolidation. You would actually be doing the consolidation. So that's how things are. You'd be applying equity accounting, you'd be doing goodwill calculation, you'd be doing consolidation. That's how things are gonna be. Now, so this is in general that you have to do with respect to it. Now let's just start discussing and let's just start looking at things that what are the things, how exactly are we going to do the accounting, etc., etc. So every single thing that's relevant, we are going to discuss that now. Okay, so if I talk about the Sterling company, if I talk about the Sterling company, I hope that you people have the handout. I've already shared with you people the WhatsApp link, and I hope that you people have the handout so that I've shared with you people the link for this specific WhatsApp community. So just in case if you want to know, if you want to look at, okay, so for the Sterling company, what is actually happening is that the first thing that you need to do with respect to Sterling company is that you need to calculate the investment in associate as at 1st December 2000 X8, because you see what actually happens is that um, as at 1st December X8 you would have to do some consolidation. Let me just show you what was the requirement of the question. See, the requirement of the question was explain how Berthold company will be accounted for, including calculation is Sterling company consolidated profit or loss for the year ended 31st March X9, right? That's what they are asking you for, and that's what we are gonna show them. But let me just do some calculations, then I'll just open up a Word file also so that I could draft out the relevant answers for you people so that you could just see that okay, what's the answer going to be. In fact, I could have even drafted out the answer in the spreadsheet also, but anyways, I mean, like, good and better to do it on the Word. Okay, see, investment in associate as at 1st December 2000 X8. So if I talk about the investment in associate, you would say the cost of investment. We knew the cost of investment was $25 million. Add share of post acquisition profits. The 40% multiply by the profit uh, okay, let's say at first reserves at 1st December X8, reserves at acquisition date. So if I talk about all of this, what is actually going to happen? Try to understand this. Reserves at acquisition date, we know it from the scenario that the reserves at acquisition date were what? We were just being told that the retained earnings were 18 million. What else were we being told? We were being told that at this acquisition date, the reserves were zero. There were no other reserves. So, in fact, what I would say is that net assets at 1st December and net assets at acquisition date. So when you talk about this, the net assets at acquisition date is that share capital, retained earnings. 10 million was the share capital. The retained earning was 18 million. Hence, resultingly, it was 28 million, right? How much was it? It was 28 million. That's one thing, right? Let's talk about the second one. The second one is basically share capital. That is 10 again. Uh, so you've got share capital, which was 10 again. How much was the retained earning? Retained earnings was 42.3. Hence, this is going to be 52.3. So you would have this 52.3. Now let's just have a bit of a discussion about all this. Okay, so 24.3 is the post acquisition reserves share of investment share in this associate was 40%, right? So basically, you would say this multiplied by 40%. Hence, what would happen is that this is the investment in associate at 1st December X8. This is an investment in associate at 1st December X8. Right? So, the investment in associate at 1st December X8 was established at 34.72. We have been given the task of performing the accounting for the whole year ended, right? So we'll do some calculations. I would do all the calculations and then I would just connect it. This is for part A. In fact, this is for part A1. Let's talk about for part A2. What is the requirement for part A2? It says explain and show how the goodwill in Berthold company would be calculated at 1st December exit, because up till 1st December exit it was an associate and now it has actually become your subsidiary. So how the goodwill should be calculated, let's have a bit of a discussion about goodwill calculation also. So you would say, first of all, the remeasurement of existing investment of 40%. How would you do that? You would say fair value of investment at additional acquisition date. How much is the fair value of the investment at additional acquisition date? So additional acquisition was done at 35%. The amount that you paid was 41 million. Fair value of net assets was this. Let's just do this fair value. We do have a fair value estimate also. We were being told, I think, something like that. The market price of Berthold shares immediately prior to acquisition was this 9.2. So if it is like this, you would simply say 40% multiplied by 10 million shares multiplied by $9.2. So it's actually what? It's actually 40% the original holding multiplied by 10 million shares multiplied by 9.2, which is the market value of each share. So 36.8 carrying amount of existing investment. How would you get the carrying amount of the existing investment? That is going to be on the basis of investment in associate at 1st December X8. So that was 34.7. So 2.08 is basically the gain in fair value. What would you do? You would be recognize this in P&L. This should be recognized in P&L, right? What it should be done is that it should be recognized in the P&L. Now, what next is there? So we have now discussed one aspect, which is the associate. We have discussed the second aspect, which is remeasurement. Now we need to talk about, again, A2, the goodwill calculation for investment in subsidiary. How is it gonna happen? You would say the fair value of existing interest, which is 36.8, cost of additional acquisition was 41. The non-controlling interest, which we will calculate, it's actually, since now you have got 35 plus 40, 75%. So it's actually going to be 25% multiplied by 10 million multiplied by 9.2, right? So that's actually 25% multiplied by 10 million multiplied by 9.2. Less fair value of identifiable net assets. Share, okay. We were being told some fair value, I think so. Okay, since we have to establish the fair value adjustment of land also, I'll just go about doing the calculation like this. I would say share capital. I would say retained earnings. The other reserves term to be 0. Fair value adjustment for land. So it's actually gonna be 10 million. Retained earning is 42.3 million. The total fair value was 55.3 million. So hence this is going to be this minus 3 million. So this is what the goodwill is going to be, 45.5. So I bet this is what the goodwill is gonna be, 45.5. Now what we need to do is that we need to actually discuss how the accounting would be done. Okay, one more calculation that is required to be done is that basically the share of current year's post acquisition, okay, post acquisition profit for the current year is going to be 11.1 multiplied by 4 divided by 12. 3.7 million. 3.7 million. Now let's start off. How would we go about discussing the accounting for this sterling company? The Berthold company, the investment in Berthold company of 40% provides significant influence over Berthold company to Sterling, and hence the investment shall be classified as associate. In the statement of comprehensive income for year ended 31st March 2009, the Berthold, the share of profit of Berthold for the first 8 months period till 30th November 2008 shall be presented as a single line item as income from associate. The amount to be shown shall be 11.1 million multiplied by 8 divided by 12 multiplied by 40% is equivalent to $2.96 million. $2.96 million. Once the investment in okay, let me just go back to the requirement of the question again. For the period from 1st December 2008 till the end of the year, that is 31st March 2009, the investment in Berthold has become a subsidiary and shall be consolidated in the financial statements. And shall be consolidated in the financial statement, right? Now, what next is there? At the date of further acquisition, the goodwill, okay, the existing investment of 40% shall be remeasured to fair value as per the spreadsheet, and the gain of dollar right? Okay, now let's move on to discuss the next aspect of the question, which says explain and show how the goodwill in Berthold company would be calculated at 1st December 8. With respect to the goodwill calculation, the existing interest of 40% at its fair value and the cost of additional acquisition of 35% shall be considered as the cost of investment for the purposes of goodwill calculation. The fair value of $9.2 per share of Berthold shall be used for the estimation of the fair value of NCI and the existing interest. The fair value of net assets are available, and on the basis of the available information, the balancing figure of $3 million shall be considered as the fair value of the land. The goodwill is estimated to be $45.5 million. The goodwill is estimated to be $45.50 million as per the spreadsheet. So this is how you're actually going to answer this question. So we are done with this specific part of the question A1 and A2. If any one of you have got any questions still here, do let me know, or else I'm going to move forward now. Yeah, is everyone okay till now? Okay, we're going to take a short break for prayers. The time right now is 7:20 p.m. over here in Pakistan. I don't know the different time zones, so I'll just take a prayers break till 7:35 p.m. Pakistan time. So I'll just take the prayers break till 7:35 p.m. Pakistan time. I'll catch you people again at 7:35 p.m. Okay, guys. So, welcome back. So we are back from the prayers break, and I'm just gonna continue now and take things forward. So up till now, what have we been discussing? We have been discussing about this specific scenario. The question's name is a Sterling company. We are going through the different aspects of this Sterling company. Let's just start discussing about the other aspects of the questions, and let's take things forward. So now the next aspect of the question is basically, let's discuss. It's basically, it says using exhibit number 2, advise the directors of a Sterling company with illustrative calculations how 30% investment in malting company should be accounted for in a Sterling company's individual and consolidated financial statement. So you have to actually advise them that how the 30% investment should be accounted for in the individual financial statement and in the consolidated financial statement. Now, what is this malting company all about? Let's go through it. Let's try to discuss this. It says investment in malting company. What is it? Investment in malting company. Says on 1st July 2008, Sterling company paid cash of $2.5 million and issued loan notes with a nominal value of 1.1 million and a fair value of 1.3 million dollars to acquire 30% of the equity interest of malting company. So what did they do? They actually acquired 30% shares in malting company, and how did they pay the consideration? They paid the consideration through the cash. This was a cash, and with the loan notes of nominal value this, sorry, market value this, to acquire 30% of the equity interest of malting company. The remaining 70% in malting is owned equally between two unrelated companies. So unrelated companies means they're not connected to each other and they're not taking the decisions together. That's what the unrelated company is gonna be. Now it says all key operating decisions require unanimous consent of all three investing parties. When you talk about unanimous means everybody should agree. So when everybody should agree, that means it's a joint control. That means it's a joint control. Each of the three investing parties has the right to its share of the net assets of malting via contractual agreement. So you have a right to your right of the net assets. So 30% right belongs to you. Malting reported a loss of 0.8 million for the year ended 31st March 9, and a dividend was neither paid nor proposed. So no dividend was there. All three investing parties provided separate guarantees to malting company's bank because malting company's poor performance in the year. So that is because of the malting company's poor performance in the year. Now, what was the requirement of the question? The requirement of the question was that you had to use the exhibit number 2, and while using the exhibit number 2, you had to actually suggest the accounting for. You actually have to suggest the accounting for this malting company, that what exactly is going to be the accounting for the malting company. That's what you have to suggest. Now let's just start discussing about this. So the first concept that you people need to understand is the concept of IFRS 11, which discusses about the joint arrangements. So the first thing that I'm going to talk about is I'm going to talk about IFRS 11, which is joint arrangements. Now what is this IFRS 11 joint arrangements all about? When we talk about IFRS 11 says that the joint arrangements are usually of three types. What are those three types of joint arrangements? And it also suggests the accounting for all those three types also. One of them is called a jointly controlled asset. The other one of them is called jointly controlled operations, and the third one of them is called jointly controlled entity. So we've got three joint arrangements. One of them is a jointly controlled asset. The second one of them is a jointly controlled operations. The third one of them is a jointly controlled entity. Now let's start discussing about it. When we talk about this jointly controlled asset, I repeat, when we talk about the jointly controlled asset, what is this jointly controlled asset all about? The concept of jointly controlled asset is that whenever there is an asset which is jointly owned by two or more people, owned so that is actually going to be considered as a jointly controlled asset. A lot of things happen, like for example, huge cranes, excavators, drilling equipments, etc. Things like that. Usually, majority of this happens with respect to earth moving equipments. They're generally very expensive, and not a single party can have majority use of that. So generally, a lot of companies they purchase those earth moving equipments in combination with each other, or could happen with other things also, but generally jointly controlled asset is an asset where two or more parties they own an asset and they jointly decide about that asset, that how exactly is that asset going to be used. So whenever you have got a jointly controlled asset, how do we account for the jointly controlled asset? The accounting for jointly controlled asset is like this: each investor to recognize share of jointly controlled asset in its financial statement. So what happens is that when we talk about a jointly controlled asset, the accounting for a jointly controlled asset is that each of the investor have to recognize their share of asset in their financial statement. So I repeat, each of the investors have to recognize a share of jointly controlled asset in their financial statements. Okay, now you see what happens is that there is a question that's being asked that when we talk about a jointly controlled, so do we need to have equal ownership? The answer is no. Equal ownership is not the necessity. What is necessity is that no single party could take a decision, no single party has a control. It's a joint control of all the parties, so that's considered to be a joint control. Like no one can decide in isolation, or no single person could be left in isolation. So it should be like every single person should be consulted and every single person should be actually together. That's how it is going to be, right? Okay, now the next one of them is a jointly controlled operations. What is this jointly controlled operation? When we talk about jointly controlled operation, the concept of jointly controlled operation is that let's say when we talk about operations is a proper business that's taking place. Like sales are taking place, purchases are taking place, expenses are being incurred, the assets are being purchased, liabilities are being incurred, etc., etc. So like proper operations are taking place. That's what an operations is considered to be. So if you have got any activity which two or more parties they control, if you've got any activity which two or more parties control, so that is going to be considered as a jointly controlled operations. Generally happens with respect to the construction of, let's say, um, buildings, highways, things like that. That with respect to buildings, with respect to highways, everything, what generally happens is that this is how things actually go about. I repeat, so when I talk about the jointly controlled operations, this is how things go about, right? Now let's move and let's discuss a bit further. when you have got a jointly controlled operation, how would you account for it? So under the jointly controlled operation, each partner has to account for their share of asset, liability, income, expenses. So like for example, let's try to understand this thing. For example, if you have got, let's say, 35% share of operations. So what happens is that when you're going to be when you're going to be preparing your financial statements, so in the sales, you would say your own sales plus 35% multiplied by the sales of the other company. Your own cost of goods sold plus 35% of the other company's cost of goods sold, things like that. That is something that you would have to do. So that's how things go about. So you account for these all in your financial statements, right? So every single item which is asset, liability, income, expenses, every single thing has to be added up like this. What we generally say is that we call it a proportionate consolidation. I repeat, we call it a proportionate consolidation, right? What do we say? We call it a proportionate consolidation, right? Now let's move a bit forward and let's take things further. The third one of them is called a jointly controlled entity. Now what is this jointly controlled entity? So everything is the same. It's simply when you have got a jointly controlled operations and you convert them into a separate legal entity. If you have got operations and you convert them into a separate legal entity, that is going to become a jointly controlled entity. What is it going to become? It's actually going to become a jointly controlled entity. So this jointly controlled entity is also termed as joint venture. I bet this jointly controlled entity is also termed as joint venture, right? What is it going to be termed as? It is going to be termed as joint venture. Now what happens with respect to joint venture is that the joint venture is accounted for in the same manner as an associate. So the IAS 28, which is now termed as associates and joint venture, actually gives you the accounting for joint venture. And under this, what are you simply gonna do? You're gonna simply account for it using the equity method of accounting. You're gonna simply account for it using the equity method of accounting, right? What is it? You're gonna simply account for it using the equity method of accounting. Now let's move a bit forward and let's discuss a bit further. So I've told you that what a joint venture, jointly controlled entity is going to be and how you would account for it. Now the scenario is that how exactly are you going to account for it? So with respect to the separate financial statement, there's something called separate financial statement, there's something called consolidated financial statement. Now with respect to separate and consolidated financial statement, what is it that you need to understand? You need to understand one thing. The separate financial statements, what you need to do is that you can account for it using cost. You can record it as at fair value through P&L. You could record it as at fair value through OCI. You could record it using the equity method of accounting. There could be different methods that you could adapt in order to account for in the separate financial statements, right? With a consolidated financial statement, there is only one way to record, and that is the equity method of accounting. That's it. So there is only one way of accounting, and that is equity method of accounting. That's what you have to do with respect to the consolidated financial statement. So if I talk about this specific scenario where we talk about the IFRS 11 joint arrangements, so this is something that you would have to keep in your mind. I repeat, this is something that you would have to keep in your mind. Now let's just start discussing about this scenario. Let's just go through it. Let's just try to look at it. Okay, Malik Aman, what we are up to is that we are doing the examination questions. And my objective is that I'll go through the examination questions on different topics, including consolidation, including the other areas like different accounting standards. That's what the agenda for the session of today is. Okay, so let's just start discussing. It says investment in malting company. So the investment in malting company, we have to, the requirement of the question is, okay, let's just start discussing about this scenario. Investment in malting company, that's something that you have to talk about. Your year end is 31st March 2000 X9 and you have acquired it on 1st July X8. You have paid cash of 2.5 million and issued loan notes with a nominal value of so and so, so and so. Okay. The investment in malting company, joint venture, accounted using equity method of accounting. Investment in joint venture. Cost of investment, cash paid, fair value of loan notes issued, 2.5 million, 1.3 million, 3.8 million, add share of post acquisition reserves. So 30% multiply by bracket open. Malting reported a loss of 0.8 million for the year ending 31st March 2009. Okay, so 0.80 million multiply by you have this investment from 1st July. That means April, May, June, 3 months out. Multiply 9 divided by 12. And in fact, it's actually a loss. So it is simply gonna be like this. नहीं सब सही है. It is simply gonna be like this. 0.18 million is the loss, that is your share. So if 0.18 million is your share of loss, ultimately what's gonna happen is that ultimately it's gonna be 3.62 as an investment in associate, as an investment in joint venture. So the investment in malting company, when you would be discussing it, you would be actually giving a bit of a background. You'll not just go about doing the scenario. You'll be giving a bit of a background also. The first thing that you have to do is that you have to understand this thing, that the investment in malting company of 30% gives a joint control over malting company, as the owners of other 70% are unrelated and all the decisions require unanimous agreement between the parties. The under the IFRS 11 joint arrangements, since the investment is in an incorporated entity, therefore malting company shall be considered as a joint venture and should be accounted for using equity method of accounting in the consolidated financial statements. The carrying amount of malting company for the consolidated financial statements shall be 3.62 million as per the spreadsheet. With respect to the separate financial statements of a Sterling company, the entity has a choice of recording the investment at either of the cost or at fair value through profit and loss, or as at fair value through other comprehensive income, or using equity method. In case if equity method is adopted, the carrying amount shall be the same for the consolidated and separate financial statements. In all other cases, the carrying amount shall be different for both individual and separate financial statement. Sorry, for the separate and consolidated financial statements. Okay, so let me just zoom it out for you people so that you could have a look at it. Yeah, is everyone okay till now? Any questions on this, please? Okay, lovely. I hope that the screen is not blurred anymore now, right? The screen is clear now? It's not clear. It's not clear. Okay.